Most investors believe risk is volatility. They believe risk is daily fluctuation. They believe risk is red numbers on a screen. But volatility is noise. Fragility is structural. And structural risk is what destroys capital. Let's define fragility in precise terms. A fragile system is one whose performance deteriorates disproportionately when exposed to disorder. Small shocks to large damage. Robust systems absorb shocks. Anti-fragile systems benefit from shocks. This framework comes from complex system theory and was popularized in finance by Nassim Taleb. But the idea is older than modern markets. Engineering, biology, and ecology all study structural resilience. Financial markets are not different. They are adaptive systems with feedback loops, and fragile structures fail under stress. Here's the first uncomfortable truth. Fragility hides in periods of stability. During low volatility environments, leverage increases. Risk models compress expected drawdowns. Correlations appear stable. Liquidity appears permanent. Investors increase concentration. The system feels strong, but strength under calm conditions is not evidence of resilience. It is often evidence of hidden dependence. Consider long-term capital management in 1998. Nobel laureates, sophisticated arbitrage models, diversified positions, high Sharpe ratios. The portfolio appeared robust until Russia defaulted, correlations shifted, spreads widened, liquidity evaporated. Leverage amplified losses. The system collapsed not because of poor intelligence, but because fragility was embedded structurally. Now let's talk about correlation fragility. Diversification works under stable correlation regimes, but during crisis, correlations converge toward one. In 2008, equities fell, credit fell, commodities fell, emerging markets fell. Diversification failed because liquidity became the dominant factor. When funding stress appears, everything sells. Not because fundamentals align, but because liquidity becomes scarce. If your portfolio depends on stable correlations, it is fragile. Another layer is leverage fragility. Mathematically, leverage reduces the distance to ruin. And suppose you lose 10% unlevered. You recover with 11%. If you are 5 times leveraged, that 10% becomes 50%. Now you need 100% to recover. Drawdown asymmetry becomes brutal. Leverage converts normal volatility into existential threat. Fragility is often simply excessive leverage disguised as optimization. Let's go deeper into drawdown mathematics. Losses are nonlinear. A 20% loss requires 25% recovery. A 50% loss requires 100% recovery. A 70% loss requires 233% recovery. Deep drawdowns destroy compounding, and compounding is the only real engine of wealth accumulation. Fragile portfolios allow drawdowns that permanently impair growth trajectory. Robust portfolios limit drawdown depth. Limiting drawdown increases long-term geometric return. Now consider tail risk. Most models assume normal distributions. Markets do not behave normally. They exhibit fat tails. Extreme events occur more often than Gaussian assumptions suggest. Fragile portfolios are optimized for average conditions. Robust portfolios are designed for tail events. Stress testing under 2% daily volatility means nothing in a 10% daily shock. The tails determine survival, not the mean. Here's another uncomfortable dimension. Smooth returns often signal fragility. And strategies that produce steady gains with low volatility may be selling hidden convexity. Example, short volatility strategies, carry trades, yield enhancement products. They produce consistent income until a volatility spike wipes out years of gains. High Sharpe ratios during calm can hide catastrophic tail risk. Fragility hides in concavity. Now let's talk about liquidity fragility. Liquidity is not constant. During crisis, bid-ask spreads widen, depth disappears. Margin calls trigger forced selling. Assets that look liquid become illiquid. If you cannot exit when needed, your system is fragile. Liquidity is abundant when you don't need it, scarce when you do. Robust portfolios assume liquidity can vanish. There's also structural fragility from concentration. Concentration increases payoff magnitude, but it also increases ruin probability. Conviction is not protection. If your portfolio survival depends on one thesis, you are structurally fragile. Robustness requires limiting single-point failure. Airplanes have redundant systems for a reason. Markets punish single-point exposure. Let's bring in regime shifts. A portfolio optimized for low rates is fragile in tightening cycles. A portfolio optimized for growth is fragile in inflationary environments. A portfolio optimized for risk-on is fragile in risk-off. Fragility is dependence on environmental persistence. Robustness is adaptability across environments. Now let's address behavioral fragility. A structurally robust portfolio can still be behaviorally fragile. If drawdowns cause panic, if volatility causes emotional override, if you abandon your system under stress, then fragility is psychological. Structure must align with emotional tolerance. Otherwise, discipline collapses exactly when it is needed most. Now let's discuss anti-fragility. Anti-fragile portfolios benefit from disorder. Examples: holding optionality, owning long volatility exposure, maintaining dry powder during panic, allocating small capital to asymmetric bets. These positions may lose small amounts during calm, but they expand during stress. Anti-fragility sacrifices small, steady gains for explosive protection. Most investors dislike anti-fragility because it feels inefficient during bull markets, but anti-fragility preserves optionality. Here's a structural principle. The objective of investing is not maximizing return. It is maximizing survival-adjusted return. Survival is prerequisite to compounding. If your system cannot survive stress, expected value does not matter. Asymmetry does not matter. Second-order thinking does not matter. Liquidity analysis does not matter because you will not be there to benefit. Now let's make this brutally practical. To reduce fragility, limit position size relative to total capital. Avoid leverage unless thoroughly stress tested. Stress test under extreme historical conditions, 2008, 2020, 1987. Assume correlation convergence in crisis. Cap maximum portfolio drawdown. Maintain liquidity reserves. Design exit rules before stress appears. Separate long-term capital from speculative capital. Most investors do none of this systematically. They optimize for return during calm, and hope stress will be manageable. Hope is not robustness. There's a paradox here. Fragility often increases slowly and invisibly. Robustness often feels inefficient and boring. During bull markets, fragile investors appear brilliant. During crashes, robust investors survive. And over multiple cycles, survival wins, because compounding requires continuity. The final uncomfortable truth: markets do not reward those who predict best. They reward those who endure longest. And endurance is structural, not emotional, not intellectual. Structural. If you remember three things from this video: first, fragility hides inside stability. Second, leverage, concentration, and tail risk amplify collapse probability. Third, survival is the foundation of compounding. In markets, the goal is not to avoid volatility, it is to avoid breaking. Because once you break, opportunity no longer matters.